Welcome to the deep dive. It is Wednesday, March 4, 2026.
Glad to be here.
And if you are tuning in today, you probably already know that we are living through this absolute globe-altering artificial intelligence boom.
Yeah, to say the least.
Right. It is no longer just a novelty. I mean, AI is fundamentally reshaping how we work, how capital flows through the markets, and frankly, how the entire global economy is structured.
It really is.
But for you, the listener, someone who really wants to cut through the relentless tech jargon and the daily market noise, the most important question isn't about, what a new chatbot can do.
No, the chatbots are just the surface.
Exactly. The real story is about who is physically powering these systems, where that processing power actually lives, and ultimately who stands to capture the immense wealth being generated by it.
And that is the hidden reality of the tech sector right now. We all see the flashy applications and the continuous rollout of new language models. But underneath, every single one of those software interfaces is an invisible, highly constrained physical layer.
The actual hardware.
Right. We are talking about the silicon chips, the specialized data centers, the industrial-scale liquid cooling systems. That physical infrastructure has become the absolute bottleneck of the 21st century.
And that brings us to the core mission for our deep dive into the source material today. We are unpacking the strategy of E2E Networks.
A really fascinating case study.
Yeah, they are India's homegrown cloud service provider, and they are currently executing an incredibly aggressive high-stakes transformation.
They really are.
They are moving away from being a standard run-of-the-mill cloud player and reinventing themselves entirely as an AI-first cloud platform.
Yeah.
I mean, they are looking directly at the global giants.
The hyperscalers.
Right. Amazon Web Services, Microsoft Azure, Google Cloud, and they are stepping into the ring to compete.
It is a remarkably bold move. And to understand how a domestic player even attempts to take on companies with trillion-dollar market caps, we have pulled together a pretty comprehensive stack of recent sources.
We really have.
We are looking at their Q2 and Q3 financial data for fiscal year 2026. We also have their January 2026 investor presentation and a pivotal January 9 press release detailing a vast NVIDIA GPU procurement.
Huge numbers in there.
Yeah, and to ground all of this, we are incorporating granular equity research reports from Dalal and Brocha, as well as ICRA.
So here is our roadmap for you today. First, we are going to explore the technical hardware leap E2E just executed, because you just cannot compete in this space without world-class silicon.
Possible.
Then we will unpack the financial numbers to see if their explosive growth trajectory actually holds up to scrutiny. After that, we will analyze a game-changing strategic partnership with the infrastructure giant L&T.
Which is massive.
A move that essentially anchors India's entire sovereign AI ambition. Okay, let's unpack this. We have to start with the headline event from January 9, 2026. E2E Networks announced they successfully procured 1,024 NVIDIA B200 GPU clusters for their Chennai data center.
What's fascinating here is the sheer generational leap that hardware represents. To put this in perspective for you, the listener, the B200 is part of NVIDIA's Blackwell architecture.
Right.
For the last 2 years, the entire tech world was fighting tooth and nail over the previous generation, the A100s and H100s.
Literally begging for allocation.
Exactly. But the B200 is an entirely different beast. It offers vastly improved energy efficiency and upgraded tensor cores. According to the press release, these 1,024 clusters collectively offer about 184 terabytes of GPU RAM.
I want to stop you right there because as someone who tracks the financial side of these capital expenditures, that number stands out. 184 terabytes of GPU RAM. We are not talking about standard storage space on a hard drive here.
Not at all. Think of standard storage like a filing cabinet where you keep information until you need it.
Okay.
GPU RAM, on the other hand, is like the size of your active workbench. If you are trying to train a highly complex next-generation language model, and the sources specifically call out models like DeepSeek, you need a gigantic workbench.
To hold everything at once.
Right, to hold billions of parameters in active memory all at the exact same time. Okay. You also need unparalleled memory bandwidth to move data across that workbench at lightning speed.
Wow.
The B200 infrastructure is purpose-built for that exact kind of heavy lifting. It reduces the time it takes to train these massive models from months down to weeks or even days.
So if you are out there wondering how AI systems are suddenly processing complex logic faster, or how they are achieving reasoning capabilities that feel instantaneous, this is the engine behind it.
Exactly.
This vast footprint of active memory is what makes real-time, zero-latency applications possible.
And latency is the enemy. When you look at the applications moving into the mainstream healthcare diagnostics, analyzing medical imaging in real time, autonomous systems navigating unpredictable city streets, or high-frequency financial analytics,
Can't have lag.
you absolutely cannot afford a 2-second delay. You need the compute power situated properly, and it must be immensely powerful. That is what this Chennai deployment represents.
Let's talk about the scale of that Chennai facility. The sources show E2E currently has around 5,000 cloud GPUs active across its platform. They have 10 megawatts of data center IT power capacity.
Right.
9 megawatts are currently active, with 1 megawatt held in reserve. But they aren't stopping at 1,024 B200s.
No, the documents indicate an incredibly aggressive scale-up plan. Their goal is to deploy between 2,048 and 4,096 Blackwell GPUs by the end of this month, March 2026.
That is a massive sprint.
They are sprinting to capture the market demand while the window is still open.
And that sprint takes us right into the financials, which is where my reporter instincts start firing. You simply cannot buy thousands of state-of-the-art NVIDIA GPUs without moving a serious amount of capital.
It requires immense funding.
Right, but E2E is showing explosive top-line growth to back it up. Let's look at the numbers. In Q2 of fiscal year 2026, revenue rose 21% quarter-on-quarter to 43.8 crore rupees.
Call it growth.
But then you look at the Q3 momentum I highlighted in the Dalal and Brochure report, and operational revenue shot up 60% quarter-on-quarter to 700 million rupees.
That kind of quarter-over-quarter growth is rare, even in the tech sector. It shows that new hardware workloads are going live and client utilization is ramping up almost immediately upon installation.
But I want to push back on something here because there is a glaring contradiction in their Q2 numbers that might confuse an investor just glancing at the headlines.
Okay, let's hear it.
In Q2, their EBITDA margin earnings before interest, taxes, depreciation, and amortization improved significantly. It jumped from 29% up to 41%.
Yes.
The long-term guidance even suggests they will hit around 70% EBITDA margins as these new B200s scale. Yet, in that exact same quarter, they reported a net loss of 13.5 crores.
Right.
As a financial reporter, when I see a company boasting about expanding margins but posting a multi-million rupee net loss, red flags go up. Walk me through that.
If we connect this to the broader realities of building cloud infrastructure, it makes perfect sense. This is a classic heavy capital expenditure cycle. The loss of 13.5 crores in Q2 was almost entirely a non-cash impact. It was driven by the severe depreciation load from activating highly expensive, brand new infrastructure.
So you're saying the loss is purely an accounting artifact of plugging in new servers?
Essentially, yes. Imagine you build a state-of-the-art automotive factory. The day you cut the ribbon, your depreciation costs hit the books heavily, but you haven't sold enough cars yet to cover that specific accounting metric.
Oh, that makes sense.
It is an indicator of aggressive forward scaling, not a failing business model. We have to look at the unit economics, which are incredibly strong.
And the sources break those down.
They do. They note that global realizations for these advanced GPUs are around $3 to $4 per hour of compute time. Once the client utilization scales up, those hourly rentals yield 75% to 80% EBITDA margins.
That is a huge margin.
It is. The near-term profitability headwind from depreciation will be quickly offset by the cash generated as those servers fill up with workloads.
Which begs the natural question. If they have all these expensive new servers sitting in a Chennai data center, who's actually renting them right now?
That is where the government steps in. A major catalyst for filling that capacity comes from the India AI mission.
Oh, right.
This is a sweeping, government-backed initiative designed specifically to foster domestic AI innovation and reduce reliance on foreign platforms.
The numbers on that are significant.
Yeah.
E2E secured 2 major orders from the India AI mission totaling 265 crores.
Massive orders.
One contract was for 88 crores and another for 177 crores. And the focus of these contracts is entirely on training domestic large language models.
Which, again, is exactly the workload the new B200 clusters are designed to handle. Having guaranteed government-backed demand gives management incredible confidence in their forward guidance.
Because they aren't just guessing if clients will show up.
Exactly. They had previously set a target to reach a monthly recurring revenue, or MRR, of 35 to 40 crores by March 2026.
Which is 350 to 400 million rupees.
Right. Because of these specific Indie AI mission contracts, management stated they expect to hit that target ahead of schedule.
They're projecting GPU utilization will jump from the current 35% to 40% range, driving all the way up to 80% or 90%.
You have the cutting-edge hardware, you have the localized, subsidized demand, and E2E is just connecting the two.
Okay, let's unpack the competitive landscape, because this is where I find myself a bit skeptical.
Fair enough.
Beating AWS or Microsoft Azure sounds like a fool's errand. AWS has practically unlimited capital. They can subsidize their cloud computing costs with their retail arm. Why wouldn't Amazon or Google simply lower their regional prices and crush a local player like E2E before they gain a foothold?
It is a valid concern, and it would be a losing battle if E2E tried to match them feature for feature. The traditional hyperscalers offer a broad, heavily bloated suite of services.
Everything under the sun.
Exactly. They have thousands of microservices, legacy enterprise support, and complex billing structures. The Dalal and Brocha research report points out that E2E is playing a very specialized game.
How so?
They focus entirely on the 10% of infrastructure that makes up 80% of clients spending the raw, accelerated compute power. By stripping away the bloat of those legacy services, they offer mission-critical performance at roughly 30% of the cost of their global peers.
Wait, 30% of the cost. That is a 70% discount on compute power.
Yes.
That is an unbelievable optimization for an AI startup that is burning through venture capital.
And the reason they can sustain those margins at that price point isn't just because they bought the right hardware. They have spent the last decade building a fully in-house proprietary cloud software stack.
They didn't just buy off-the-shelf software.
No, you cannot build a stable cloud platform overnight. It is forged through years of handling real-world workloads, optimizing server loads, and iterating software. That proprietary stack is their hidden moat.
But even with a great software stack, scaling up physical servers requires massive infrastructure. To go from a scrappy challenger to a true enterprise powerhouse, you need friends in high places.
You absolutely do.
And that brings us to what might be their ultimate advantage: the strategic partnership with Larsen & Toubro, widely known as L&T. The sources show L&T infused 1,079 crore rupees for a 19% strategic stake in E2E.
This raises an incredibly important point about the physical realities of the AI boom. Yes, the 1,079 crores is a vital capital injection. It funds this aggressive procurement cycle without forcing them to take on toxic debt.
Which is key for their balance sheet.
But the money is almost secondary to the operational synergy. L&T is a marquee engineering and infrastructure institution in India. Their backing signals to the largest enterprise clients that E2E is secure, stable, and ready for mission-critical workloads.
And it solves a very practical problem. Where do you put 4,000 highly advanced, incredibly power-hungry B200 servers?
The real estate and power bottleneck is the silent killer of AI infrastructure companies globally.
People forget that part.
They really do. You can have all the capital in the world to buy chips, but if you don't have a data center with specialized liquid cooling and an industrial power draw, those chips are just expensive paperweight. Through this partnership, E2E gets prioritized access to L&T's state-of-the-art data center facility in Chennai. It completely removes the physical bottleneck from their growth equation.
Let's zoom out a bit.
Yeah.
Because all of this hardware, the soaring financials, the L&T partnership, is all serving a much larger, almost philosophical shift in the tech world. We need to talk about the concept of sovereign AI.
This is perhaps the most important macro trend we will touch on today. Sovereign AI is the principle that a nation's data, and more importantly, the intelligence and models derived from that data, should reside entirely within its own borders.
Subject to its own legal and regulatory frameworks.
Precisely.
So ground that for the listener. What does it actually look like in the real world?
Imagine an Indian healthcare startup that is aggregating millions of localized patient records to train a diagnostic AI. Under emerging data privacy laws, sending that sensitive biometric data to a server in Virginia or Frankfurt to be processed by a foreign tech giant is becoming a massive regulatory liability.
And frankly, a national security concern.
Exactly. Countries are realizing that relying on foreign infrastructure to train their most critical AI models leaves them incredibly vulnerable.
And E2E is explicitly building an India-based, open-source-driven cloud platform to answer that exact concern.
They are leaning right into it.
In their investor presentation, they outline their operating philosophy, which they call the 5 A's of E2E Cloud. These principles are affordability, assistance, accessibility, accommodativeness, and Atmanirbhar Bharat.
That last principle, Atmanirbhar Bharat, translates to a self-reliant India. It is a major national initiative. E2E is positioning itself not just as a business, but as the vital infrastructure layer required to make digital self-reliance a reality.
Tarun Dua, the managing director of E2E Cloud, made this vision very clear in the recent press release.
He did. The goal is to keep next-generation AI computing accessible, highly efficient, and locally available to Indian enterprises and researchers so they never have to compromise on performance to meet data residency requirements.
The market opportunity here is difficult to overstate. The Dalal and Brocha report includes a statistic that really frames the severity of the situation.
What is it?
Currently, India generates about 20% of the world's global data. Yet the country possesses less than 2% of the world's global compute power.
It is a profound mismatch. You have a fire hose of raw data and a tiny funnel to process it. But from an investment perspective, that bottleneck is a decadal opportunity.
It's massive.
E2E is building the bridge over that gap. They are aiming to be the premier AI-first platform that captures that missing 18% of compute capacity.
And the broader market is absolutely taking notice. Looking at the investor sentiment in the research reports, expectations are sky high. Based on E2E's unique market positioning, the strong unit economics we discussed, and the high barriers to entry, Dalal and Brocha issued a target price for E2E Networks of 4,320 rupees.
That is a bold target.
Based on the market prices noted in the report, that represents a 94% upside, utilizing a 15x EV to EBITDA multiple. They are essentially treating this stock with a scarcity premium because it is one of the only listed homegrown AI cloud infrastructure plays available.
And it makes complete sense why institutional investors would view it through that lens. They are operating in a highly capital-intensive space where they have somehow maintained EBITDA profitability since their inception.
Which is exceedingly rare for cloud challengers.
Extremely rare. And now they are strapped to a rocket ship of domestic demand driven by the broader AI boom.
So let's recap the journey we've taken through the source material today. We started with the technical hardware leap. E2E procuring 1,024 NVIDIA B200 GPU clusters, bringing 184 terabytes of active GPU RAM to Chennai to handle the next generation of complex trillion-parameter models.
Right.
We tracked the financial trajectory, seeing Q3 operational revenue spike 60% as they lock in lucrative India AI mission contracts to train domestic algorithms.
Hitting those MRR targets early.
Exactly. And finally, we looked at the ultimate competitive moat, a 1,079 crore strategic partnership with L&T that secures the physical real estate and power they need to scale, allowing them to offer specialized compute power at a 70% discount compared to global giants.
If we connect all of this back to the bigger picture for you, the listener, whether you are allocating capital in the markets, whether you are a developer building new AI tools, or if you're simply trying to understand where the tech space is heading, you have to realize that the physical location and the cost of compute power is the invisible hand guiding the future of the internet.
The physical constraints dictate everything.
Exactly. The software algorithms get all the media glory, but the physical data centers dictate what is actually possible.
It really is the foundation of everything coming next. The silicon is the new oil.
It is. And that leaves us with a final, rather provocative thought to consider moving forward.
Let's hear it.
We have spent this time discussing the localized control of data through sovereign AI and how companies like E2E are building the domestic refineries for that data. But if compute power is the new oil, what happens when the global supply chains for the drilling equipment tighten?
Oh, wow.
With the United States heavily regulating the export of top-tier silicon to various regions, the next great geopolitical battle might not be over who controls the borders of the data. It might be over who is legally permitted by foreign superpowers to purchase the physical chips required to process it in the first place.
That is a sobering thought.
Yeah.
It is a complex, rapidly evolving space, and we will be keeping a close eye on how this infrastructure race unfolds globally. Thank you for joining us on this deep dive into the source material. We appreciate your time, your curiosity, and we will catch you on. Welcome to the deep dive. It is